if that happens, then expect gold to be turbocharged, and even my upside targets may prove to be somewhat conservative. But
welcome back to Metals and Miners. I'm its founder and its host, Gary Boehm. We have a fantastic discussion lined up today that I am super excited about. We have Kevin Wadsworth, co-founder of North Star Bad Charts, with us to wade through many charts and break down what is going on in the world of gold, silver, uranium, copper, and so much more, to give us his projections based on what the charts and the evidence are saying. In his former life, Kevin was a military meteorologist who for the last 15 years has taken his charting and predictive talents and has been applying them scientifically to forecast market movements. Kevin, thank you so much for joining us today.
Hey, Gary, it's great to be here. Thanks for inviting me on.
Yeah. Kevin, will you explain how your background in military aviation atmospheric forecasting has translated over to utilizing and applying scientific predictive principles to forecast market movements?
Yeah, sure, Gary. Well, it was a case of just a gradual realization, I suppose, over the course of sort of several years back in the early part of the 2000s, really. And I was had my head down doing my forecasting and just concentrating on my career. And it just gradually started to dawn on me as I was getting involved in investments, and particularly the gold market, as it happens. And we all know what happened to gold during the early 2000s, and then we, of course, had the financial crisis. And I started looking at the charts in a kind of scientific way, but in a way that a forecaster, a meteorologist would look at them, looking at it from a numerical point of view and trying to see if there's any patterns in there, any correlations, anything that could give a little bit of a sort of an advantage for someone who was trying to time the markets. And over the course of several years, it sort of turned out, to me that yeah, you can do that. There are techniques that we use in aviation forecasting and atmospheric forecasting, particularly around the use of statistics and probabilistic forecasting that uses computer models. And these computer models gather all the available information, all of the available evidence, and put it together. And you can do that with the markets. You can gather the evidence from a technical point of view from the markets. Don't need to sort of really consider fundamentals at all, because the charts themselves are the fundamentals, all the fundamentals that everybody knows about, and nicely put down in a chart for us. So I think if you can learn the language of the charts and learn the science of the technical analysis, then you can get a real edge.
That's amazing. And I'm super excited to dive into a bunch of charts with you today to see what they're all saying. So let's begin with the markets. Kevin, you recently shared a chart showing Nvidia reaching a specific price point that you stated that if reached, it meant that the entire stock market is facing very high risk. Will you speak into what you're seeing here with Nvidia and how much risk that the market is facing? And now that Nvidia has reached this price point, how much of a likely market decline is possible that your analysis is pointing to?
Yeah, there's a lot to unpack there, Gary. I'll share my screen and I'll show you the chart. And this is the Nvidia chart that we're talking about. And I think everybody's probably aware of this chart. I posted it when it was breaking out back down here somewhere, and it was passing through a clear resistance line on the chart somewhere around $500, $600. And I'd identified, along with plenty of other people, I'm sure, this major resistance line. And Nvidia, I kind of sort of thought it would probably take several months to reach that sort of resistance level, and that later on this year, when it reached the target, which was somewhere around about $1,000, that at that point, being a very clear major resistance, and the stock markets having moved so far so fast, that there is a high risk of a significant correction. Now, that doesn't necessarily mean that the stock markets are going to roll over and Nvidia is going to collapse all the way back down to the support line here, which would be a drop of over 70%. But what it starts to do is bring increasing risk of a significant drop. Brings that risk sort of onto the table. There's nowhere for Nvidia to go really, except slowly creeping along underneath this resistance line, which can only continue for so long, or it sends the market a major signal. And that major signal would be a breakout above the resistance line that would lead into some kind of melt-up type scenario where the markets go crazy in what I would think would probably be a sort of final blow-off scenario for this bullish leg in the stock markets, or we get a clear rejection here, and a clear rejection would look like a drop below horizontal support. There's some horizontal support around $800. So I think if Nvidia makes a clear move below $800 and the technical chart pattern that it builds out during that process, if it doesn't look like some kind of bullish chart pattern and doesn't have bullish technicals hidden within it, then that would start to really increase the risk that we're going to see a drop, certainly back down to the $500 level, which is, it's roughly a 50% drop from where we were, $1,000 down to 500. So we are at a high risk point here, and we're seeing it in the markets now, Gary. We're seeing a certain amount of nervousness in the markets as we hit key levels, key resistance levels, and these are evident right across the markets. You can look at Nasdaq, you can look at Nasdaq versus inflation, Nasdaq versus gold. You can look at a number of tech stocks which have already rolled over, of course, and companies like Tesla have been in an ongoing bear market for a long time now, actually. So there are a relatively small number of mega cap stocks that have been really pushing the market north, whilst underneath the surface there have been signs of weakness for some time. So nervousness is understandable at this point, but I'm not going to say that the market is ready to break down just yet. I had anticipated and still think that we may continue to tread water or move a little higher over the next few weeks and months, but it'll become very clear, I think, over the next 2 or 3 weeks. We've just failed to see some key moves on the quarterly close. Of course, March was a quarterly close, and had we broken out on the quarterly chart for Nvidia, then that would have laid to rest some of those concerns. And just the very fact that we're hesitating, pulling back here, does start to make me nervous, certainly.
So yeah, and so it seems to me like all the charts that you're designing and that you're pouring through, you're trying to expand your evidence cluster, so to speak, so that you could increase the probability of a good move, and at the same time decreasing the risk that's being applied to your investment.
100%. And as a trader, as opposed to an investor, what is key with technical analysis is identifying low risk, high reward entry points. Where we are now, there's no low risk, high reward entry point on Nvidia. The low risk, high reward entry point was when it broke out back down here somewhere near $200. And then when we came up to the major resistance here and broke out, that was another low risk, relatively high reward entry point. The same thing happened here when we broke out again, particularly at the $500 level. But now that we've hit resistance, the risk is relatively high, and the reward at the moment is pretty much non-existent because we're right up against that key resistance line. So there's no traders trading entry here. In fact, this is a place where you would be unloading your position had you spotted this breakout level here. So that is one very good reason why price is pausing where it is, of course, because everyone that played that move will be taking profits at this point. And the big question is, are we about to build towards another leg higher, or is this going to roll over in a more meaningful way? And that'll, as I say, become very clear in the next probably 2 or 3 weeks, or certainly during this coming quarter anyway. That's how we use the charts. We use the charts to identify low risk, high reward entry points, and in certain situations, confidence levels can be high. It's about confidence levels. It's like playing a game of poker. You know what hands what cards you've got in your hand, and that's what increases your confidence level. You need to have situational awareness. You need to know how the odds are stacked and how the evidence is stacked. It's all about the evidence, and if you've got good, strong evidence to give you a good deal of confidence, then you can play your trade with an increased NAV risk if you're using your net asset value, risk reward protocols, and all that kind of thing, which of course everybody should.
Yeah, and because Nvidia is a poster boy for the Mag 7 and the run up that we've seen with AI and everything, are you looking at Nvidia as a beacon for the overall market, or at least for the Nasdaq? So meaning where Nvidia goes, so does everything else?
Well, Nvidia's a $2.26 trillion company now. So if that were to fall 50%, I don't suppose it would do the Nasdaq much good. It would be looked at from a market perspective as being a leading indicator of tech stocks. And just, I wouldn't expect the Nasdaq to hold up if Nvidia starts to decline. Put it that way. I can't see that Nvidia would decline with a backdrop of a rising Nasdaq. So if Nvidia rolls over here, then yes, I expect Nasdaq to follow it, and I expect the sort of nervousness and by that stage perhaps even mild panic would start to pervade the markets. I think everybody and his dog is currently aware of the fact that the market is very stretched and has moved a long way in a relatively short period of time. And there's a lot of factors out there that that are potential banana skins for the stock market and for the economy more generally, actually. And we're in a very different investment environment now to what we've been seeing over the last 40 plus years, and I've been sort of trying to hammer this home a lot. What's going on in the background to all of this is very, very different to what we've had over the last 40 years. So my particular view is, we have some issues.
Yeah, so several weeks ago, you posted that when the Dow Jones breaks down versus gold, capital rotation takes over and a bull era is born. Is the weight of evidence that you're looking at pointing to a breakdown in the Dow and even the Nasdaq and S&P for that matter?
Yeah. So you can use ratio charts in technical analysis, and you can compare one investment vehicle versus another. Now, if I just put this on the quarterly view here, so these are quarterly candles now on the chart. Each one of these little red and green candles represents 3 months price action, and you can see very clearly a pattern emerges, and that pattern is very clear even to the casual observer. And when you look at it more closely and you put on the gold chart, you can pick out the tops for gold bull markets and the bottoms for gold bear markets. Now, this is the Dow to gold ratio chart. It shows you basically when the Dow breaks out versus gold, or when gold breaks out versus the Dow. So gold breaking out versus the Dow happens when this chart breaks to the downside. If the chart's moving up, the Dow is outperforming gold. If the chart's moving down, gold is outperforming the Dow. So for precious metals enthusiasts, you want to see this chart moving down, and you need to identify when you are at a particularly high point and are breaking down. So if you're at a particularly high point and breaking down, the probability of being at the beginning of a precious metals bull era is very high. You can see, historically speaking, back in the early 1930s, that happened, gold bull era. Same thing happened in the late 1960s, early 1970s. This thing broke down and led into a huge precious metals bull era. Same thing happened just after the turn of the century, 2000, 2001. This thing broke down. It was confirmed breakdown in 2002. And we know what happened to gold between the early 2000s and 2011. Now, it's essential that everybody now realizes that what's been happening over the last 3 years or so, in fact, it goes back further than that. It actually goes all the way back to the gold peak in 2011, 2012. And what's been happening since then is just a mere pause in a precious metals bull market. And we have only begun to see the very, very early stages of that. So the move from $1,000 to 2,000, sorry, I beg your pardon, from $250 to $2,000 was just a warm up for what we're seeing. And in particular, the move from $1,050 to $2,000 is just a very slight hint at what's coming, because the chart has very clearly now shown us that we've built out a bearish pattern. This pattern, this rising wedge pattern, is quite common. It's very common. It's well known to technical chart analysts. And when it breaks to the downside, when you see this chart breaking down, it's giving a strong signal that we are now entering a prolonged period where this chart will continue to move down. If I zoom right in, with gold doing what it's doing at the moment and moving up past $2,200, we're starting to see this Dow to gold ratio chart breaking down. Now, any slight weakness in the Dow now is going to push this down even further. So we're right on the verge of being able to say that we are getting strong evidence from this chart that we're entering a new precious metals bull era. And in fact, you can see me just moving this support line. It's actually arguable that we've broken down quite sort of convincingly already. There's always a little bit subjective where you place these support and resistance lines. In reality, they're zones of support, but it's now becoming increasingly clear that we're starting to see this chart pattern break down, and that's increasing the evidence that we are now about to start the next leg in the precious metals bull era.
You know, this is really interesting. If you zoom back out on this chart, but stay on, you know, on the right side here from 1981, where it begins, the Dow begins to take off. That area right there, to me, looks a lot like the chart that has been shared a lot about the psychology of a market cycle, and how right now it's been in the complacency stage.
Absolutely, yeah. Yeah.
And then it drops off into despair and anger and despair and the rest. It really looks awfully similar to that.
And you know, technical chart analysts will, you know, by and large, be very good at spotting these patterns because they repeat over and over again. It's not some kind of voodoo or dark art. It's human emotion. What you're looking at. And I have to stress this: it's not some, as I say, not some kind of voodoo. It's not some kind of dark art. We're seeing market sentiment and human emotion conveniently drawn on the chart for us. And as you said, you know, this huge period from 1980 all the way up to 2000 there, you see this in stock markets, you see it in multiple markets, you know, across all sectors, where you get a huge run up, then the bear market starts to take hold, then you get a period of recovery, and everybody thinks, oh, it's back to the new normal, everything's recovering. And talking about the stock market, we've actually made nominal new highs in the stock markets, of course. But if you do the stock market versus gold, the stock market versus inflation, that's not the case. So if you plot the stock market versus gold and inflation, it looks very much like this. So we are trying to make new highs, but just slightly failing to do so. And it's very reminiscent of that well-known market psychology drawing that you're referring to.
Very interesting. Well, let's turn over to the U.S. dollar here. Kevin, a few weeks back, you shared that channel support within the U.S. dollar index is very likely to be tested. Then what? So what does your analysis of the chart here lead you to forecast regarding the U.S. dollar for the remainder of 2024 and into 2025?
Yeah, the dollar's a bit of an enigma. There's certain markets and charts that I find sometimes quite difficult to get a real handle on. Precious metals I don't seem to have too much trouble with, but when it comes to certain particularly currencies maybe, but the US dollar index is sometimes very challenging and tricky. But we can clearly identify over the last year or more this descending wedge pattern. The background on here, by the way, it's Fibonacci retracement levels. And so far, the pattern has been panned out pretty much according to what I expected. So I put this chart out as we're starting to break down back here in sort of late last year. And my projection was for each of these support levels to be tested. And that as long as we don't break out, then the likelihood is that we come down to somewhere below 100 on the DXY. Now, just at the moment, DXY is threatening to break out. And if you notice, DXY has been moving up and up and up over recent weeks, 1, 2, 3, 4 weeks now, but it hasn't stood in the way of gold. And that's interesting. Gold has been doing just great, regardless of the US dollar index moving up. And you have to remember, of course, that the US dollar index is permanently sort of trapped between, you know, it's in a range. It's between, what, 160 and whatever it dropped down to at its lowest point, somewhere near 90, was it? So it's permanently sort of trapped. If you go back far enough on the DXY, of course, you've got a value of 160 there somewhere. I don't, this particular chart doesn't quite go back far enough, but the DXY is just an index. It's just an index, and it's comparing the US dollar to mainly the euro. So it's just showing the back and forth oscillations of the strength of the US dollar versus the strength of the euro. So DXY is kind of trapped in a range, but gold isn't. Gold just keeps on going. And over time, gold tracks loss of purchasing power. That's what gold does. It just tracks loss of purchasing power. Your dollar buys less, but gold will, over time, pretty much buy the same. You can buy a house now in the same amount of gold coins that it could in 1975. Gold is just perfectly tracked to your loss of purchasing power. So to answer your question on the US dollar index, we're testing resistance here. It's failing to break out at the moment. And my conclusion on that is that unless we break out, the next sort of major trend for the US dollar index over the next few weeks is going to be to the downside. If that happens, then expect gold to be turbocharged. And even my upside targets may prove to be somewhat conservative. But if DXY does break out here, then there's a little bit of a question as to just how much that's going to dent precious metals and gold. So I'm watching this carefully. And if we get a weekly confirmed breakout, so that would be a close above around about 104.5. It needs to be fairly convincing. So around about 104.5. If we get a weekly close there, then we'd need to look quite closely at the US dollar index and gold and all of the rest of the evidence. But at the moment, my suspicion is that this is probably going to fail to break out here. But we'll find out soon enough. If you're watching this in about a week or two's time, you'll know whether or not I was right on that.
Yeah. So bonds are once again rising. You shared your US 30-year bond yield chart, and you commented that I've been posting this chart for years now, but I'm going to keep posting it because it's fundamental to what we're facing in the next 10 plus years. Can we dive into this one and see what you forecast for us to be facing over the next 10 plus years?
Yeah, this is where I have to go back to the disclaimer that I'm a atmospheric scientist and not an economist. So I'm not going to try and step out of my area of expertise. But what I can tell you, from if you're investing, if you've got investments and if you're trading the markets, that it's very, very clear to me that the environment that we're in now and have been in since, was it 2021, 2022, when this broke out, it's actually early 2022. I said at the time, in fact, this goes back, of course, to the COVID lows. And at the time, back in 2020, this expanding descending wedge, it's a bullish chart pattern. It's bullish when it breaks to the upside. So the price action stays trapped inside this very clear expanding channel. But then when you get a breakdown, like we got back in 2020 there, you have to ask yourself, right, so that chart pattern that was bullish and telling us that we were going to get an upside breakout, instead of that, we got a huge move to the downside. Now, what we're talking about here is something that can't forever stay down near 0%. It just doesn't make any kind of logical sense that this 30-year government bond yields can stay down, dropping down towards 0% for any period of time. So my conclusion at the time, and I put this out in social media, was that I expected a violent and rapid upside move that would finally break through the upper resistance line and take us into a completely new investment era, a new paradigm, if you like. Sounds dramatic, but you get these shifts every several decades, and it doesn't happen very often in an investor's lifetime, maybe just once or twice. And it very clearly puts us in a different environment, economically speaking. What's happened here is that we are now out of this descending channel. It gives the 30-year bond yield the freedom to move sideways and higher without being constrained by this resistance line. And that resistance line was there for a reason. I actually put it onto the 10-year yield chart, which I've got here somewhere, but see if I can find it. Perhaps not. Anyway, on the 10-year yield chart, in fact, that's it there. On the 10-year yield chart, we had a similar breakout. Okay, and whether it's the 10-year yield or the 30-year yield, we've got the same message coming from the charts, and that is that we're in an environment quite similar in a lot of ways to the 1960s. We broke out through what I labeled as a pain line, and I called it a pain line because I thought if we ever break out above it, the economy and the world at large is going to experience a lot of pain. What I mean by that is that there's a mathematical problem here. Above that red line, the pain line, it becomes problematic in terms of debt and debt to GDP and debt repayment and sustainability of debt repayment. And the reason for that is that, think about it for a second, the reason that the 10-year yield and the 30-year yield stayed below that line, well, there had to be a reason. There's got to be some reason. I mean, that line doesn't just come out of nowhere. It's not some kind of magic line that just, you know, I've just kind of made up. It perfectly fits the chart, and it perfectly, every time the chart touched it, it was perfectly rejected from that line. And to me, looking at it from a mathematical point of view, it's got something to do with the amount of debt that the United States has and its ability to repay that debt, and the general economic environment at the time. So conditions were conducive to being able to contain the 30-year bond yield, government bond yield, below that line. Now, for whatever reason, that control has been lost and the bond yields have moved above that line. And that introduces an element of instability and an element of, you know, a sort of a question mark over debt sustainability, because if the bond yields are rising, if interest rates are rising, if inflation is rising, then, you know, you've got a huge mountain of debt. How are you going to manage those debt repayments as yields rise? I'm not an economist. I'm just a, you know, a technical chart analyst, but, you know, I'm posing the question and I'm pointing out the fact that something is changing here that bears a lot of similarities to the 1960s and the 1970s. So that gives us a little bit of an inkling as where we need to be looking in terms of what might be coming our way over the next, let's say, 10, 20 years.
And those are all fair questions. And those are questions I think many of us are asking, maybe just not from a technical perspective, but you're kind of framing it for us from a technical perspective, and it sheds a little bit more light. And, you know, I, for one, appreciate that. So inflation seems to be a bigger issue and not going away, as indicated by recent metrics and rising oil and other commodities going up. Kevin, in regards to a cocoa chart that you have showing cocoa going parabolic, you wrote, what's happening is much bigger than just cocoa. The commodities era is literally just beginning. Expect upward pressure on PPI, expect increasing inflation expectations, rates, yields during the next 10 plus years. So you believe we're going to be in a sustained inflationary environment, it seems like, for the next 10 years. Is that right?
Correct. Yeah. And I know a lot of people watching this are going to be probably shouting at their computer screens or whatever, looking at this on the phones and saying, look, this is ridiculous. We know why cocoa has gone vertical. It's because of, you know, the crops, you know, the supply constraints, crop failures and problems with the actual product itself. And that is the fundamental backstory, the fundamental reason. Now, that's all very true, but you can point to lumber a year or more ago, you can point to zinc, you can point to olive oil, you can point to a whole range of commodities, and it's not coincidence. And from a technical point of view, if I just take that label off and forget that it's cocoa, all I need to do is point there and say, at that point, a technical chart analyst will say we've had a breakout from a multi-year resistance line, and this chart is now going to take off to the upside. Okay, now it doesn't, I'm not really interested in whether it's cocoa or whether it's, you know, the price of beans, or, you know, whether it's aluminium or whatever it is. For a technical analyst will spot that breakout and say, right, the chart is now giving us a very bullish signal. The fact that it's gone up there is perhaps somewhat surprising, but once you get the breakout, you can then track the moving average. You can track a whole load of metrics that just keep you in a trade until a particular support level breaks down. You notice we had a couple of consolidation periods here where it pulled back a little bit, but it didn't break down. So if I'd actually been looking at this at the time it broke out myself, then, you know, perhaps I would have looked at cocoa futures and so on. So you know, I didn't actually spot this at the precise moment that it broke out. I probably spotted it when it was up here somewhere. But you can point to a whole number of commodities, and of course precious metals are included here, and silver is very volatile as well, of course. And it makes no difference whether it's something that grows on trees or whether it's something that gets dug out of a hole in the ground. There's what the charts tell you is there's a whole load of reasons, whatever they are, that has kept this commodity contained below a resistance line for a number of years. And as a chart trader, you're looking for these patterns. You're looking for multi-year basing patterns that break out. And when they do break out, you have a really strong piece of evidence, a really strong reaction, a really strong piece of evidence there that something is changing, something major is changing, the trend is changing. All of these little squiggles under here, you can try and trade these if you want to, but take it from me, it's a waste of time compared to actually getting into the trade when it's confirmed a breakout like this, which is why precious metals are so interesting at the moment as well, of course.
So you're seeing outside of cocoa, you're seeing the commodity complex, maybe not every single item within it, but maybe an index like the CRB or something is starting to move higher and breaking out of resistance lines that have been holding for years.
Yeah, it's to try and give you an analogy, Gary. It's a little bit like all of the commodities are popcorn in a pan, and given the right conditions and the heat starting to be turned on underneath the commodities sector, each piece of popcorn, whether it's cocoa or whether it's olive oil or whether it's aluminium or whether it's copper or whatever it is, sugar, it kind of pops, but they don't necessarily all pop at the same time.
Right.
Okay, you turn the heat up on this, and the reason for that is that because capital sloshes around from one sector to another, and each sector responds at a different rate to investment capital and has slightly different metrics in the way investment capital sort of feeds into that market, whether it's ETFs or whether it's mega cap stocks, whatever it is that is feeding into the sector, if it's a sector that you're talking about, or if it's a particular commodity. They're all sort of slightly unique in the way they react to capital coming their way, and some will take off vertically and some will gather steam gradually, and they'll break out and they'll back test the breakout and they'll spend a while going sideways. But the trend is kind of locked in once you get above that resistance line. So what you end up with is all these bits of popcorn just popping at different points in time. But the net effect is that you're kind of lifting everything up to a higher plateau. Everything's kind of as a whole. And if you look at the commodity ETFs and indices, you mentioned the I think the CRB index, you can look at the Deutsche Bank commodity index and all the others as well. They are showing the same signals or giving the same signals. So yes, you can track it as a whole, and you can track the individual commodities reacting to these flows of capital. And I fully accept that in the instance of cocoa, the factors driving what's happening here are unique, but you can say that about anything. You can say that about silver, and when silver does this, no doubt people will come up with stories about why silver's doing what it's doing. But I go back to the breakout. That's the bit you're interested in right there. Doesn't matter what the reasons are. I don't care what the reasons are. I'm not interested. Mm-hmm. All I'm interested in is spotting that.
Mm-hmm. Yeah, that's a good point. So, you have a really interesting chart showing how since the end of the gold standard, the debt to GDP ratio broadly follows money supply multiplied by money velocity and GDP itself. Yeah, this is the chart. So on this chart, you wrote that all of these are trending towards a vertical conclusion with profound implications. So in your analysis, what kind of profound implications do you believe can occur due to these upward trends?
The profound implications center around the sustainability of US debt and where we're going in terms of the US dollar and the sustainability of the US dollar, really. The fact that something like 96-97% of purchasing power has been eroded away in terms of the US dollar. It's kind of incredible when you stop and think, even in the last sort of few years, 10, 15, 20% has been wiped off US dollar purchasing power. And this chart pattern is basically a parabola. It's a parabola is where you begin the graph as a gradual rise, and then as you move further to the right, the graph gets steeper and steeper and steeper and steeper. And what's really happening is that a whole load of feedback mechanisms are kicking in. And the very fact that the chart is becoming steeper causes this chart to become steeper. So as you said, the black line there is money supply times money velocity. Now we can, you know, the data for money supply and money velocity is readily available on lots of different platforms, and this is TradingView, and you can multiply money supply by money velocity. Then if you overlay US GDP, okay, and if you overlay US debt to GDP, it's pretty remarkable how they're all so closely correlated.
Mm-hmm.
So GDP is rising, but debt to GDP is rising.
Mm-hmm.
Okay, and all seemingly being led by money supply multiplied by money velocity, which again, I'm no expert economist, but that's pretty much, I think, the definition of GDP. Do a bit of Googling on that one, but this is just what I sort of stumbled across looking at the charts, and very strong correlation there that goes back, more than 50 years. So there's plenty of data to support the conclusion that since the ending of the gold standard, the debt to GDP ratio broadly follows money supply multiplied by money velocity and GDP itself. So if we know that money supply and money velocity are rising, or the multiplier, money supply by money velocity, is rising, then we also know that GDP and debt to GDP is going to rise as well. So again, this is leading towards a big headache and a big problem. Not so much the fact that it's just rising, but the rate of increase is increasing, and that's the worrying part of it. If it was rising at a slow and steady rate, contained non-parabolic rate, then it wouldn't be so much of a concern. But it's the increasing rate of change which is the concern.
It'll be interesting to see if this chart maintains its parabolic movement or if it shifts, but based on history going back to, I guess we could call it the 50s, it looks like the higher probability is it's going to stay the course.
Yeah, it does. And, some of that goes back to the abolishment, if you like, of the Bretton Woods Agreement. The US dollar's link to gold was broken, and that's really what's allowed this out of control money printing to create the chart that you're looking at. Prior to that, it wouldn't really have been possible. But all things are possible seemingly when you can print money out of thin air.
Mm-hmm. All right, so Kevin, you have repeatedly shared your gold forecast, which was originally issued in March of 2019. It does not appear that you've changed your forecast at all since it was issued 5 years ago. Based on the weight of evidence that you've gathered to build out this forecast, where do you see the gold price moving to in this cycle, and in what time frame? And secondarily, does the evidence point to a multi-year pullback at some point, or more of a rise, consolidation, profit-taking period, and then a resumption of the trend higher?
Yeah, sure. Well, I'm happy to give you my view on gold. This is a chart that I found out of all the charts that I do, actually, beautifully, I won't say easy, but from a technical chart point of view, I know people talk about manipulation, and we all know about the COMEX and the tricks that they play, but whatever they're doing at the COMEX, it hasn't altered what I kind of expected gold would do. If they're, I think over the long term, any kind of manipulation is probably overridden, because this goes back to 2019, early 2019, and there's a very clear cup pattern forming on the gold chart once we got this sort of touch point down here, this perfect geometric arc. And with the help of Fibonacci extension levels, I was able to suggest that what was most likely to happen, not what's guaranteed to happen, but we always talk about probabilities when you're forecasting anything, and it's always about trying to identify the most likely outcome. And at this point, when gold was 1313, the most likely outcome was for a move over the next year or so, so during 2019 into 2020, for a move up to the previous highs at $2,000. Now, at that point, and combining this with cycle analysis, it seemed to make, and these vertical lines are the gold cycles, so you can see 2008, 2016, and this one here, which is sort of 2023, 2024. So a low point there. In fact, it's a little bit earlier, isn't it? Sort of late 2022, early 2023. And the gold cycle is anything from 7 to 8.5 years as well. So that's worth bearing that in mind. But the forecast was for the move to 2000, a pullback down to somewhere around about 1500, that kind of area, 1600. And that will create a low, a cyclical low. And then we would move up towards $2800. Now, in fact, the Fibonacci extension level is 2946. So that basic forecast, I have, as you said, I haven't changed since 2019. All we've been doing is tracking that arc. Now the arc is still there. You can see the arc pattern there, and this handle that's formed on the arc, and the low point that I was talking about there, somewhere around $1600, has formed as well. Now we're broken out above this line of final resistance, and we're at an all-time high now. So the move up to 2000, the move down to 1600, and then the breakout have all happened on course and on track. So my expectation for gold is for the move to continue. I've got a gold chart here somewhere. Let me just see if I can find it. Where did I put it? Sure, perhaps I. Oh, here we are. There we go. So yeah, the gold forecast now is for the move up to, I'm being a little bit conservative here, somewhere around $2,700. And following that, I think there'll be quite a large correction, and I think that the correction will be significant. It could even retrace all the way back down towards the 2000 area. And this low point in 2022, I think a lot of people view that as the 8-year cycle low, and I've got my doubts about that. Regardless whether it is or whether it isn't, I suspect a significant pullback after we reach somewhere in the mid to upper 2000s. And I'm saying 2700 is the most likely sort of target area. We may overshoot, but just when everyone's getting ridiculously bullish and calling for $3,000 gold, I've got a strong suspicion that we're going to pull back pretty hard, and that's likely to be in conjunction with broader market events, which is why what's happening in the stock market is so important. But following that, and if this follows the playbook that I've got as the most likely scenario, the stock markets will struggle for years to come. 1 year, 2 years, 3 years, 5 years, 10 years. We could take 10 years plus to get back to where we are at the moment with the stock markets. Now, of course, that happened between 2000 and 2012. Everybody forgets that, I think. The stock market, from its high point in roughly the year 2000, took around about 12 years to get back to that point. Now, during that period, of course, precious metals went on a real tear, and gold doubled, and then it doubled again, then it doubled again. And I think that's what's very likely to happen after the next major pullback. I think the real powerful precious metals and commodities bull era will really begin at that point. And there's a reason for that, which I think we're going to touch on a little bit later. I don't want to preempt your questions, but we'll explain why that is a little bit later on.
Okay, so just so I'm fully understanding your, can you pull that chart back up?
Yeah, sure. Yeah.
Yeah. You're seeing a move to, conservative 2700 area on this particular cycle move that we're in. Yeah. Then in conjunction with a broader decline in the market, you're expecting, you see a pullback maybe as far back down to the 2000 level. Yeah. And then at some point, while the market is languishing for a number of years, the new gold bull era will begin, and you see it being similar in nature to what was experienced in the 70s and early 2000s.
Yeah, so something along these sorts of lines. Something like that.
Yeah.
In fact, let me just be a bit more realistic about it. Something like that.
So you have maybe a 5 or 600% move.
Probably more. Yeah.
Okay, well, let's get into that in a moment. Gold has recently had a bullish megaphone breakout. Would you explain to the viewers the significance of the megaphone structure and what it implies for gold based on historical analysis of that pattern?
Yeah, so I put this chart out a while back, and this megaphone pattern is well sort of documented. You can see on the right-hand side here, eLearn Markets, this is courtesy of, and this megaphone pattern is well documented. It's in all the technical analysis books. And I spotted this on the quarterly chart last year, and sort of theorized that price was likely to break out of this megaphone pattern, or at least that when it does, it would be the signal for the next major up leg of the precious metals bull market. Now, going to the current chart.
When you subscribe, we want to give you a free gift. It's a report that we wrote based on an important Ray Dalio foundational premise titled, "If you don't own gold, you know neither history nor economics." This free gift is a must read for everyone on why we all should own gold. So head over to metals&miners.substack.com, put in your email address to subscribe. It's free, and get the free gift.